On the Morningstar website, I selected Abbott Laboratories as an example. And what you're going to see is Abbott Laboratories Morningstar credit rating. This is a credit reporting agency, Morningstar. They have an AA minus. The amount of debt outstanding is 3.8 or 3.3 billion. Corporate issue, obviously, and they're in the healthcare sector. Now, some things you want to cover for your project are going to be historical capital structure. If you look at, this is the debt and equity composition of a company. The right-hand side of the balance sheet, as you know, is debt and equity. Assets equal liabilities plus equity. So if you look at 2010, September 2010, as you can see, there was a tremendous amount of debt. And then the pie started getting, it looks like, smaller from 2010 to 2000. Right here, it's 46% was, you can see it right here, 46.7% was debt. 2012, 2 years later, 37.6% was debt. Now it's down to 26.2%, and now they're at 25.9% debt. So what that means is the debt portion of the capital structure is getting smaller and smaller. Now we want to start going down to yield to maturity. As you can see here, these are the coupon rates, 5.125, 5.3, so on and so forth. And you click on a particular rating and you can get information on it, on a bond rating. When a company sells bonds, they have their own specific bond rating. And that's the first one, 5.125, maturing in 2019. And it tells you how it's trading. As you can see, it's trending upwards, meaning people look like they're, the yield is going higher, and the yield is going higher on that particular one. And so what we want to do is start looking at these right here, 5.125, 5.3, 4125, 6156, and what we're going to find is the maturity dates, the credit quality, the price, and the coupon rate. Is it fixed or floating? And are these bonds callable or not? And what they mean by callable is, can the bonds be called in at any time? And that's something you can research in your textbook and find out the pros and cons for an issuer as far as issuing callable bonds or not. When you issue a callable bond, if for some reason the interest rates drop, you can buy the bonds back and reissue them at a lower rate. And that's a risk for investors because they can buy a bond with a coupon rate of 5.125, and if rates drop, Abbott Labs can buy it back and reissue bonds at, say, 4%. So the investor would lose money. So those are some of the things to consider and discuss. And now we're going to go on to what I mentioned was the balance sheet right here on the 10K. So we want to go to the 10K and explain how the bonds are reflected on the balance sheet. And really what's going to help us out is the footnotes in the balance sheet. One of the purposes of this exercise is to really pull apart the footnotes in the debt section of the balance sheet. So we are going into Yahoo. We go to Abbott Labs. All right, Abbott Laboratories. And you can use whatever website. This is just the easiest to navigate. SEC filings. Now remember the 10K. You'll see a 10K-A, which is amended. And we want the 10K full. Here we are. Now it's going to be different sections, so just go to Form 10K, that way you get the whole form. Here we are. We're up. So the first thing we want to do is go to the balance sheet. This is what the 10K looks like. Hopefully this looks familiar to all of you. And we're going to go to balance sheet first. With this particular section on the bottom left-hand side right here, there is a search function. So we're going to type in balance sheet first. Consolidated balance sheet, page 55. Consolidated balance sheet. Here we go. So this is historical 3 years, 2010, 11, and 12. Long-term debt. Long-term debt right here. It's going up. Now remember, the long-term debt can be other things above and beyond bonds. It could be mortgages, things like that. So we want to scroll down further. And they're not saying a whole lot about the bonds here. So what we need to do is, in all likelihood, it's always going to be in the footnotes. The footnotes have a tremendous amount of information. So just Google Notes. Or no, excuse me, don't Google Notes, but enter it in the search engine here. And we are going to go into here it is, note number 9 for Abbott Labs. And this is what's going on. Debt and lines of credit. Now what you're going to see here is, let's read the notes here. In 2012, Abbott redeemed 7.7 of its outstanding notes. Abbott incurred a cost of $1.35 billion to extinguish this debt. And AbbVie is a wholly owned subsidiary of Abbott, and they issued long-term debt as well, ranging from 3 to 30 years. Then we're going to scroll to the next paragraph down. Abbott's long-term debt rating was A+ by S&P and A1 by Moody's, and the Moody's Investor Service. They didn't mention Morningstar's rating, which is okay. Third quarter of 2012, Abbott replaced unused lines of credit of $3 billion and $3.7 billion that were to expire in 2012 and 2013, respectively, with 2 5-year credit facilities totaling $7 billion that support commercial paper borrowing arrangements. Now, commercial paper is short-term funding. It is not a bond offering. So what they're talking about here is they're talking about restructuring lines of credit and commercial paper facilities. And if we go up here, we can actually match up. Let's try to see if we can match up some of the bond issues. All right, 5.125 maturing in 2019. Look for something maturing in 2019. Yeah, here it is right here. We just found it on the balance sheet. All right. So that particular bond issue is outstanding. 5.125, 2019. Let's just see if we can find another one. 2037 or 2039. 2037 or 2039. Looks like both these right here. All right. So one thing you can see, and one thing you can notice here, is that they appear to be, I would write this up as trending downwards, meaning they are issuing bonds, and the bond offerings, or the bond debt, is trending downwards. They're building up more equity in the company, and they're retiring bonds, it looks like, and as the debt section of the balance sheet is shrinking, which is a good thing. So that's how to retire that. You would also make reference to the fact that they have other outstanding debt obligations, such as commercial paper and credit facilities, as mentioned in the footnotes. So again, just mentions a few pieces of information from the footnotes and try to describe that and show that you have an understanding of what you're talking about. For example, again, the unused, they replaced unused lines of credit right here, $3 billion and 3.7 that were to expire respectively, with 2 5-year credit facilities totaling $7 billion that support commercial paper borrowing arrangements. So what they were doing is $3.3 billion and 3.7. They increased their borrowing slightly with credit facilities using commercial paper. Okay, and make sure you understand what commercial paper is. It's short-term borrowing, and how they replaced it with unused credit facilities. So what they're doing is it looks like they're increasing their short-term credit facilities. That's a really low cost of funds because you only borrow the money for a short period of time, and that's the direction they're going in. So please mention a few other things like that, and hopefully this gives you a rough idea how to put this project together. Again, the whole scope of this project is to go ahead, understand how a company issues bonds and what it looks like as far as credit rating, maturity, are they callable or not, and then pull apart the debt section of the balance sheet as we just did a few moments ago. Please don't do Abbott Labs as I just did it as an exercise for you, but choose another company. That way you'll learn from scratch. And if you have any problems with it, please email me, not on Sunday night, but email me the next day or so, a rough draft of your work, or if you get stuck on any research, I'll be more than happy to walk you through it. Best of luck. Thank you.